Well, hello everyone, and welcome to the first Karora Resources Live Investment Summit today, hosted by Six. I'm pleased to introduce our speakers. We have Paul Huet, Chairman and CEO, and Oliver Turner, Executive Vice President. Paul and Oliver will walk us through a company presentation, and then we'll be accepting questions live. You can submit your questions at any time on the Q&A panel on the right-hand side of the screen. And as always, the summit is being recorded and will be available on Six.com afterwards. So without further ado, I'll hand it off to you, Paul.
Thanks very much, Dasha, and good morning, everyone. We're quite excited to partner with Six, and we look forward to having several other summits throughout the year. We believe this could be a really good platform and a good way for us to communicate with our shareholders. So as Dasha said, this is our first one and we look forward to several others. So I'll jump into the presentation and I hope that everyone can see it here. I'm going to start switching slides. So in the beginning, obviously, we got our forward-looking disclaimer, so please go through it. We will be discussing some forward-looking statements throughout this deck, both Oliver and I. As we walk through this deck here, we're going to take a two-pronged approach. We're going to look back over 18 months, what we have accomplished, and then we're going to look forward into what's coming up here. And both Oliver and I will be speaking throughout the deck. Here's some of our course gold that we've seen through our Beta Hunt mine that several people are very familiar with. Our mines are located in Western Australia, right southeast of Kalgoorlie, one of the most prolific areas in the world to be mining, as we know. Myself, Paul Huet, I've been with the company. I joined as a director in the fourth quarter of 2018. I've been CEO for approximately 18 months now. It's been a very exciting and aggressive 18 months, I have to admit. Prior to this, I was president and CEO of Klondex from its inception to its sale to Hecla in 2018. More importantly, the gentleman to the right of me here, Graham Sloan, our managing director who heads up our Australian operations. Graham was the former CEO of Perseverance. A lot of people are familiar with the Fosterville mine from Kirkland Lake. Graham was the president and CEO from 2002 to 2007, responsible for building that mine. He was also the CEO of Tanami and Herentia. Graham is a strong operator, has a strong network in Western Australia, but as you can see, he also has a commanding understanding of capital markets. That makes my job and our company tremendously more successful because of his background and experience. And together, we've managed to really shape up and change the operational team that we have in Western Australia to see the success that we've had over the last 18 months. This slide that I'm going to talk about here really is going to show the stuff that we did over the last 18 months. It's important to take a snapshot and see where we were to where we got to. So 2020 was a transformational year for this company. You know, we just on the heels of buying the HGO mill in 2019, getting that up and running for the first 6 months. 2020 was our first year ever to put out guidance. Our guidance for the year was 90 to 95,000 ounces. As you can see in the bottom right, we successfully beat the guidance, getting up to 99,000 ounces in our maiden 12 months with our own mill. The guidance for 2021 is actually a 21% increase over last year's guidance. But what was our focus in 2020? We wanted to make sure that we reduce costs on all fronts. We wanted to remain focused. So one of the decisions we made as a board and as a company was to divest our nickel asset in Quebec. We owned the Dumont nickel project. By the time I became CEO, we only owned 28% of the asset. So 72% of that asset was owned by another group. We finally sold that remaining 28% to the other group. That did several things for us. We sold it for up to $48 million. We still get to participate in good nickel prices on the final sale of the asset. So we got $11 million right out of the gate when we sold it. We applied that towards some of the share buyback, the royalty buybacks, not the share buybacks. We put those dollars towards those royalty buybacks. But more importantly, one of our objectives that we said we would do was reduce costs. So this helped us in many ways by selling off the nickel asset because we were spending about $2.6 million a year in G&A costs. So we said we'd reduce G&A costs. That was one way. That's at 100,000 ounces a year. That's $26 an ounce. And we look at it a per ounce metric all the time, trying to reduce that AISC. The other things that we focused on to reduce G&A were the royalties. If you look on the top right here of this slide, we reduced 3 royalties, and those were quite aggressive. Some of these royalties had been in place for almost 2 decades. So we'll start off with the Morgan Stanley royalty. We completely removed or eliminated the NSRs in that royalty at Higginsville. We did it in 2 phases, working with Morgan Stanley, and that's about a $45 per ounce cost savings. So that's a huge savings for us and our shareholders going forward. And it really unlocked that district. When we acquired the Higginsville mill, it had 1.8 million ounces of resource, total resource, measured, indicated, and inferred. But a lot of those resources that existed were on a land package that had this massive royalty on top of it. So we've eliminated that royalty. Then we followed up with Mavericks at our Beta Hunt mine. We had a 7.5% royalty at Beta Hunt. We managed to reduce that by 37%. And look, let's face it, Mavericks is a royalty company. That's their business. So managing to do that was a huge success for us. And again, another $42 per ounce saving, which is tremendous for us going forward as we look into the future. And then because we were doing so good at reducing those 2 royalties and spent so much time in the corporate office getting those resolved, we had bought the Spargos property. And that Spargos property, we've showed some drill results, and Oliver's going to talk about some, but just as a recap, we had hit 19 meters of 27 gram. So it's and then 29 gram over 50 meters. So it's a massive deposit. It had a 3% royalty. So we wanted to set ourselves up because we're going to be mining. We're going to be into Spargos here at the end of Q2, beginning of Q3. We've always said it was starting in 2021. We're on track to do that. The pre-stripping probably get done in Q2. So removing that 3% royalty from Ramelius not only accomplished reducing costs, it delivered on that item that we said we're going to focus on reducing costs. We said we'd reduce costs in 4 areas when we first started the mill up. We said G&A, and you hear how we're reducing costs in G&A. Royalties, you can hear how we're doing it. Vendors, we said we would meet with the top 20 vendors. We did that. We met with the top 20 vendors because we now had cash in hand, a sustainable production. We could demonstrate that we could pay our bills on time. We negotiated long-term contracts, and that translated to about a $38, very close to $40 per ounce reduction in our costs as well. And the last thing we said we'd do is we'd focus on the 4th thing was operations. And look, operationally, we've reduced our turnover time from 87% that it was down to 15% lower than the average in Western Australia. We've improved productivities underground by about 30%. We've improved recoveries in the mill. We've reduced the milling costs. We were paying about $55 a ton, $50 to $55 a ton, depending on where we were toll milling. When we originally got the mill, it was down to $29 a ton. We're down to about $25 a ton already, and we're doing a mill upgrade this year. It's not very expensive, about $3 million. It's going to increase the mill by a significant amount, by about 550 tons per day. That's a big part of how we're growing that 21%. People have asked me numerous times, well, how are you growing the 21%, Paul? Well, part of it is that mill increase, that extra 550 tons a day that's going to come in at mid-year. That's about $3 million is how one way that we're going to increase the production this year. And then grade's going to make up the second part. And Oliver will talk about that. And before I go to the other slide, I just want to talk about a couple other things. Again, this is a look back. It's important to look back to where we were. 18 months ago, I remember sitting on a call in Toronto and on a quarterly call and disclosing that we had a negative $8.7 million in working capital. You know, it was a tough situation to walk into, but we were up for the challenge. We delivered, and we ended 2020 with $79.5 million in cash. That's a huge turnaround and a very focused management team on driving success here. Our shareholder base, we were continually attracting and marketing towards institutional shareholders. We're well above 15 new institutional shareholders. It sits anywhere from 55 to 60% of our register now that are institutionally held. At the AGM last year, we had a vote where we put it to our shareholders to vote on the share consolidation. It was unanimously voted in favor with over 90% in favor. We actually did a 4.5 to 1 share consolidation. That share consolidation helped us in several ways. What it did do is a lot of the institutions that we had been marketing to that were unable to buy our stock because it was below $1, then had the ability to buy it. And they're long-term. They're sitting here, they're saying, look, we're 3 to 7 years is our platform. So a lot of funds we marketed to in the beginning said we can't buy below $1. So we were very mindful of that. On top of that, several of the funds explained to us that they needed, in order to use additional margin accounts to buy the stock in a lower section, they needed a share price above $2. So we were mindful of that as well. But more importantly, since we've done the share consolidation, our liquidity on a daily basis has gone from about $2 million to $4 million per day. So that's a tremendous success with that share consolidation that we had. And then lastly, before I switch slides, the 2P reserve that we put out in 2020. This was the first time we put out a 2P reserve on our own with our own numbers with both Beta Hunt and with HGO. And I just want to remind people that that high-grade Spargos reward property was excluded from that reserve that we put out. Yet we put out a 2P reserve that was 1.3 million ounces. Look, I've been in mining 33 years now, in Canada, the US. I've consulted in Australia, South Africa. Never in my career have I had a 2P reserve of 1.3 million ounces. That's a tremendous reserve. And behind that, we've got 2.5 million ounces of measured and indicated in resource. So we're off to a great start, having reduced the royalties and setting up our district now and thinking about the district as a whole. We really have an opportunity to start drilling. And you'll see how we've increased our drilling. So this next slide here, our drilling for 2021, our exploration and all our drilling, we've increased it from 15 million to 20 million on the heels of, again, reducing all those royalties. We have a lot more targets. And again, these will be talked about on the forward-looking section. I'm talking about the rear view stuff. This slide here on the top table here, there's a function here where I can draw. So let me try using that. So on this top table here, on this blue row, these are the quarters since we bought the mill, Q3 all the way to Q4 of 2020. And then the row below it, that gold row, are actually the ounces and the costs. So as I was pointing out, the focus on reducing costs, if you look quarter after quarter, each of these quarters here, one all the way to the 6th quarter here, we have successfully managed to reduce costs every quarter. And that's by working with the vendors, royalties, the G&A. Every quarter since we got that mill, we have been reducing costs. Prior to owning the mill, our costs were about $1,300 to $1,400 all in sustaining costs. The first quarter ever, we achieved 1,183, 1,183, and then the last quarter that we reported was 1,044. Our goal for the year was to get to 1,000 for the year. We're going to put out our results for the quarter here in the next couple weeks here, or actually next week, I believe. It's actually next week. And you'll see that we're on track to once again achieving our goals. This picture that you have in front of you here is a really good picture or a snapshot of our plant. Today it's being fed by Beta Hunt, the underground operations, and then that's on the left-hand side here. Maybe I can draw a circle around that. Yeah. And then on the right-hand side here, you see our Higginsville operations, and they're feeding that centralized mill today. And as I pointed out earlier, it's a 4,000 ton a day mill. We're going to be increasing that mill to 4,500 to 4,600 tons per day this year, mid-year here. Along the way, some of the drilling that we had in 2020 has been very successful for us, and we intercepted the new Larkin Zone at Beta Hunt. Oliver's going to talk more of it in detail. That's been some of the successful drilling we had in 2020 from that $15 million that we spent, and that grade in that area is almost twice the grade that we're mining, the average grade of Beta Hunt now. So we're quite excited to get into it. We're going to start drifting and development into it in 2020. We're putting in infrastructure in there now, some ventilation. We're accessing this area through the old workings from the mine that existed, the nickel mine that existed in the past. And just before I turn it over to Oliver, I just want to talk about another decision that we've taken as a company. So 2020 was a big year for us. It was a successful year for us and our shareholders. 2021 is going to be another big aggressive year for us. In order to deliver our plan and the things we want to do in 2021, I've made a decision to relocate myself and my family to Western Australia. Today is March 11th. We fly on March 23rd. So this is happening very quick. And as a result of my departure over there, there's going to be several things that I'm going to be working on and focus on. We're going to be looking at marketing at new institutions there. There's superannuation funds over there. Our marketing has been very focused in North America for the last 18 months. So going to Australia to meet new accounts, market over there is going to be really critical. More importantly, helping Graham deliver on this growth plan. And growing the company. We're sitting at 100,000 ounces a year. Are we satisfied? No. We'd love to see our company between 200 and 250,000 ounces a year. In order to do that, we need more people over there to make sure we successfully deliver. And then lastly, we're going to be looking at an ASX listing. So evaluating that is going to be really critical here in the coming months. So I'll be in quarantine with my family effective the 24th. So that's a really good snapshot looking backwards. And I think it's important to reflect on where we come from and now where are we going. As a result, again, of me going to Australia, Oliver, who knows the story very well, our executive vice president, he'll be taking up a lot of the marketing in North America while I'm in a different time zone. So with that, I want to turn it over to Oliver, who's going to give you a good glimpse of what we have coming up here in the next couple months and what you can expect from 2021 before we turn it over to Dasha for some questions. So Oliver, if you want to go ahead.
Yeah, thank you, Paul, and hello, everyone. So as Paul talked about, let's shift to forward-looking information here and see what we have in store for the year ahead, and then I'll step through each one of the assets that we have and talk about some of the exciting results we've had over the last several months and where those assets will be going over the course of this year. So on this slide, you see, it's a Gantt chart of our objectives for 2021. We are going to be updating the market in the second quarter here on our multi-year consolidated growth plan. We're targeting to give the next 3 years worth of guidance there. And we're incorporating some exciting new information that we've received fairly recently into that growth plan and are certainly keen on getting that out to the market. That'll also be accompanied by a new resource at Spargos. As Paul mentioned, the Spargos reserve and resource was not included in our fourth quarter estimate. That was for a very good reason, a very positive reason. We announced some tremendous results that came later in the fourth quarter last year, and I'll step into those a little bit later on, but an ounce per ton over 19 meters. We wanted to make sure that we're able to incorporate those results in our updated Spargos resource and reserve. So we elected to pause that fourth quarter update and incorporate that into the resource update we'll be putting out in the second quarter here by mid-year. Followed by mining startup at Spargos, and Paul mentioned the phase 1 mill expansion that we're working on. Very low cost of capital, or very low capital rather, to execute on that plan. Of course, lots of drilling to come. We're putting $20 million into the ground. All of this will tie into a reserve and resource update towards the end of the year, and then of course we're continuing to execute on evaluating that ASX listing opportunity. So these are our properties in Western Australia. You can see Kalgoorlie is located in the top of this diagram here, and I'll try to get a little drawing here where I can outline it for you guys. There's Kalgoorlie here. So that's where the super pit is. Of course, 60 million ounces have come out of that super pit. We're about 65 kilometers down the road to our Beta Hunt operation, and another 70 kilometers down the road to our Higginsville mill, which is shown in the middle of the Higginsville central box down here. Our Spargos Reward high-grade pit is adjacent to Beta Hunt over on the western side here. And we have another project, Mount Henry, to the south as well. So the reserve and resource update, I'm not going to read out all the numbers on this slide, but I would argue that it certainly caught the market by surprise with respect to the quantum that we increased our reserves and resources last year. That was despite the fact that our good friend COVID-19 managed to park our drills for about 5 months. The reason for that was we had, if you weren't mining gold on our property, you weren't allowed on the property as part of our precautions. Third parties were not allowed on site. That unfortunately included third-party drillers. So despite that, the team did an incredible job accelerating our drilling program. We did about 50,000 meters in the fourth quarter last year, and we've continued at a very high pace this year. One comment and question that we do get a lot from retail are delays on assays. Unsurprisingly, with the amount of cash that was generated in Australia last year, the gold prices that everyone enjoyed, there are significant demands on labs in Western Australia with respect to getting assays in. So they have overwhelming demand, and at the same time, personnel shortages due to the COVID-19 border closures, which prevent people from outside of Western Australia flying in, flying out easily without quarantine. So that has led to a significant delay in assays. We reached up to 2 months there at one point in terms of returns of assays, exploration assays specifically. Grade control is a faster turnaround, obviously due to mining requests. But we're happy to say that those delays are starting to ease up, and we would expect them to ease up over the course of 2021 here, certainly as vaccines start to take hold and the COVID-19 pandemic is hopefully behind us, but all for very good reasons. Everybody's generating cash. Everybody wants to explore. We're excited to get our results out. And when we do get the results, we release them to the market. So stepping into Higginsville, which we decided to split into 2 regions in the fourth quarter of last year, called Higginsville Central and Higginsville Greater. You see on this diagram on the left-hand side, Higginsville Greater is outlined in turquoise there, and then Higginsville Central is inside of this red box. That's about a 10-kilometer radius around the mill, and it's what we're calling our high-grade core of feed at Higginsville. So for all intents and purposes, that's going to be what fills the Higginsville mill from the Higginsville portion for many years to come. That 2 gram reserve that we have, 220,000 ounces, predominantly open pits. The M&I and inferred resources behind that start to incorporate some of our underground opportunities, which I'll talk about a little bit later on. And then you see Higginsville Greater, which has 1 million ounces at 1.3 grams. That's obviously not going to be displacing ore through the Higginsville mill anytime soon. So we are evaluating a potential 4th project down at Mount Henry to the south, which we've conducted a PEA on, evaluating the metrics there. Mount Henry is adjacent to some very interesting properties owned by Pantoro, of course, who've had some phenomenal high-grade results. And we're looking forward to drilling out Mount Henry more this year to improve some of the grade profile there. But we certainly have a substantial amount of ounces there. As I mentioned, we also have Beta Hunt and Spargos. The Beta Hunt reserve and resource continued to grow last year, as you see in the table at the top of this page right here. We also had, the Spargos Reward resource, 4 gram resource, and then you see our consolidated resource and reserve there as well. That Spargos resource will be updated, as I said, in the second quarter. Let's step into Beta Hunt here. Beta Hunt is our underground operation. You see on this page one of our new underground haulage trucks. It's a 60-ton haulage truck that we have there. It's been part of the driver of our improvements in productivities last year and continued decline in operating costs. Those are performing very well. We added 2 of those last year. We in our capital program this year, we'll be adding another 2 this year. If we step into the asset here, one of the important things to note about Beta Hunt is that long before it was a gold operation, it was a nickel operation. In fact, this nickel operation started in 1974, and for the better part of 35, 40 years was a nickel mine. Now, part of the benefit of that you see on this page here, we have substantial underground infrastructure in place at Beta Hunt. In fact, we have over 400 kilometers of existing underground infrastructure in place at Beta Hunt. And we've been leveraging that both for mining and for exploration purposes. You see the infrastructure on this page. The 2 areas that we're mining right now at Beta Hunt are the A zone here. This is where our current resource and reserve are. and western flanks. And we've had some tremendous exploration success, not the least of which Paul mentioned earlier is the Larkin Zone shown here and in green here. These are vertical gold shear zones. They're very continuous and very easy to add chunky additions to resources and reserves in, as we did in the fourth quarter of last year. And we've had some tremendous exploration success following the renegotiation of the Mavericks royalty, which we announced in September last year. The first major success that we had was at the Larkin Zone. So if you look at the blue inset in the lower left-hand side of this page here, you see A zone and western flanks. This is a plan view, which we're currently mining today. Those are truncated, if I was to switch colors here to make it more easy to see, those are truncated by the Alpha Island Fault. And south of the Alpha Island Fault, where we have all of this existing underground development, we discovered the new Larkin Zone, which is down here. Now, the Larkin Zone was discovered in an existing underground development drift that's been in place for over 25 years, which you see right here. That's hosted in basalt, which is extremely competent rock. We do not backfill at Beta Hunt, and the condition of that drift is absolutely outstanding. We channel sampled the walls, and we ended up finding a 14-meter intercept of 5 grams per ton. And we knew immediately that we had found another one of these very large vertical gold shear zones on the other side of the Alpha Island Fault. Not only that, but if you look at some of the drill results in gold on this page, which are shown here in red inside of the vertical shear zone, those grades are approximately twice the grade of what we're currently mining. Now, it's not in resource or reserve yet. That will obviously enter resource and reserve for the year-end 2021 update, but we're certainly very excited to see what that can do to the grade of Beta Hunt. And of course, we generated significant free cash flow at the average grade of 2.7 grams per ton last year. So anything incremental to that is, of course, profit. So definitely a very strong zone. We've drilled it off over 400 meters of strike extent so far. And we've also seen some tremendous nickel success. So the 30C nickel trough was the first new nickel discovery at Beta Hunt in over 13 years. And some of the grades in the nickel are reaching 7%, which is absolutely outstanding, and will continue to drive our byproduct credits going forward. This is another follow-up to the Larkin Zone that we announced just a couple of weeks ago. Infill drilling is going very, very well. We announced an intercept of 9 meters at 19 grams per ton in the Larkin Zone, so it continues to support that thesis that the Larkin Zone is going to be a higher grade area of this mine. As Paul mentioned, we're currently getting additional ventilation capacity installed in the Larkin Zone so that we can get haulage trucks down there later this year. We're doing some test mining there right now, just drifting through the shear zone and getting some pretty interesting results, both in gold and in nickel. So stay tuned for further developments on that over the course of this year. We also announced another discovery in September of last year, which was an extension of the Western Flanks area we're currently mining to the north, up plunge. Remember that this area was mined for nickel, but not for gold. And we discovered a new footwall zone at Western Flanks North, which we've extended at so far over 160 meters. We believe we can extend another 280 meters to the north. But if you look at those grades, those are typical of what we're currently mining at Beta Hunt. So that 2.7 gram reserve grade is fed by those kind of drill results. So again, these are all bode well for chunky additions to the resource and reserve update towards the end of 2021. Coarse gold. Coarse gold is certainly a hot topic for Beta Hunt, and it's certainly something that put formerly RNC Minerals on the map and brought in many of our investors. Coarse gold is something that we continue to encounter at Beta Hunt, and the environment in which it occurs is much better understood now. But one of the fundamental changes we've made is the way that we mine Beta Hunt. Prior to owning our own mill, which lowered our milling costs from $50 a ton down to $29 a ton overnight, it was uneconomic to mine that 2.7 gram reserve grade material at Beta Hunt. The addition of that mill made all of the material economic. So what we are doing now is we are mining out the entire shear zone. And importantly, any of the coarse gold that occurs in the stopes that we mine, which is the entire shear zone, so the entire width of this shear zone is mined in open stopes, we get 100% recovery of that material in our gravity circuit at the front end of our mill. So we do not lose any coarse gold. What we are not doing is what the company was reliant on previously, which was essentially drifting or tunneling through those shear zones in order to try to find these high grade pockets, which, while of course is very exciting when you do hit them, you're basically losing money while you're drifting there trying to find them. So in the end, it's an exercise in futility with respect to potentially bankrupting yourself looking at trying to search for those things. So long hole stoping these entire shear zones has changed the fortunes of this mine. We still encounter the high grade coarse gold targets. In fact, we announced one in a drift that we saw on the face in December of last year, about 2,000 or 2,500 ounces. And we understand the environment in which it occurs much better. Importantly, the environment in which it occurs is where you see this pyritic sediment layer, which I will draw on this page right now. So this pyritic sediment layer right here, where that crosses these vertical gold shear zones, you get an area which I like to call the hot zone, or we've labeled here a high-grade coarse gold target. Now, those areas occur over the length of all of the shears that we've drilled off. So there's actually about 16 kilometers worth of potential for this pyritic sediment. But importantly, with respect to the coarse gold, what we're making sure to do is not sterilize any areas in the mine. So we are long hole stoping, and that requires, from a mining stress perspective, in order to manage the stress regime of the underground mine, sequenced mining where we retreat in a very methodical manner that's dictated by the stress regime. So we are taking these stopes in order dictated by stress. And of course, the coarse gold will come when we encounter it. So we're certainly very excited about it, but this is a much more stable operation with that wonderful coarse gold kicker moving forward. Let's take a step into Higginsville here. Higginsville is obviously a very, very large property. We acquired this in 2019 as part of the acquisition of the mill. We have many targets we've been drilling over the course of 2020, and of course we will be in 2021. As I said before, we've bifurcated the resource and reserve into two areas, Higginsville Central and Higginsville Greater. But let's take a look at Higginsville Central, which is that high-grade high-grade core feed to the mill for the next several years. When we acquired the property, we inherited a list of 32 brownfields targets, and those were anywhere from prior open pits to advanced exploration targets. What we did over the course of 2020 was drill off a lot of those targets, not as many as we would have hoped due to that 5-month pause that we had, but nevertheless, we got a high degree of confidence rather, in many of those open pits, which we're mining today. So Baloo has been the backbone of this operation for a significant period of time, located in the lower right-hand side here. We're now mining Hidden Secret and Mouse Hollow, which are merging into one larger open pit, and Fairplay North, which has for the time being reached the end of its open pit life. There's an underground opportunity that we're looking at and evaluating there as well. High level, these are broadly speaking 1.8 to 2 gram open pits, head grade to the mill. So very profitable open pits that have delivered a significant amount of free cash flow for us over the course of 2020. Now, obviously, there's some very interesting high-grade underground opportunities at Higginsville as well, not the least of which is Aquarius. Aquarius is right next to Fairplay North here, just a few kilometers or about 1.5 kilometers from our Higginsville mill. You see some of the results we have at Aquarius in the lower left-hand side of the slide here. What we did last year was we drilled Aquarius back up towards surface in order to delineate an economic starter pit, which we've now started earthworks on. We expect Aquarius, the open pit material, to start contributing to Higginsville's grade profile by mid-year of this year. And then, of course, we'll get into more exciting underground material at Aquarius towards the end of the year and into next year. And that resource grade, which is from previous owners Alistair Gold, is about 19 grams per ton. So you've got 2 gram open pits, you've got some higher grade underground opportunities. Aquarius is one of them. Two Boys is another area which we put on our social media. We've been dewatering that area. We're going to go back in underground there as well. So what you're going to see over the course of 2021 from Higginsville and of course from the company as a whole is quarter over quarter improvements in grades as we track through the year, which is obviously great from an investment standpoint. What we ended up doing at Higginsville last year, while those drills were paused for 5 months, and if you talk to our head of geology about what he was most excited about in this company, it would certainly be the Lake Cowan results that we ended up releasing just a few weeks ago. Lake Cowan is an area that is not actually a lake, it's a dry salt lake bed. You see it outlined here on the graphic. We conducted a large gravity survey over 400 square kilometers of it, which is outlined in black here. And we overlaid that with a structural analysis of the region, and we came up with some very interesting targets that we have since been drilling. Now, I'm going to draw a line down this page here, but all the way up from Kalgoorlie to the north, the major structure that hosts all of these large deposits runs right down through our property from Kalgoorlie past us to Norseman to the south. And that area runs right underneath Lake Cowan. So we have some very large gravity anomalies where those two areas were crossing over each other, and we had some tremendous success. What we were drilling for was anomalous gold. We use a specialized air core rig, which is a very light rig, which can go out into the salt lake bed, and you drill methodical fences of holes over that lake. We're looking for anomalous gold, which is anything over 0.02 grams per ton. But what we ended up drilling with our first pass drilling with this reconnaissance drill rig was what we would actually consider ore, 1.35 grams over 50 meters. So that was a tremendous result. We're wrapping up that reconnaissance program towards the end of this month, and then we'll be following up on some of these results with RC drilling and, of course, diamond drilling later on. But that area is looking very, very interesting for us. And of course, we're surrounded by very large deposits. So the north of us, Goldfields is mining from 2 deposits under the dry salt lake bed that total about 7 million ounces. So we're certainly in the jurisdiction for very large deposits, and we want to make sure that we're not sitting on, or that we drill one of the large deposits if we're sitting on top of it. So excited to continue to announce results from that as they come forward. This is the results of that geophysical survey or gravity survey I talked about and some of the areas that we targeted. We also, in gravity, discovered a very interesting area north of the past producing Trident mine. Trident mine was operated by Alastair Gold. They produced 1 million ounces out of Trident at about 5 grams per ton. In fact, that's what they built the Higginsville mill for when they owned the property. Now in gravity, we uncovered a new 5-kilometer long structure, which has never been drilled before. Again, all of these areas were under that royalty, which crippled the asset for many, many years. So we are going to pop some holes into Trident over the course of this year and see what we can find. But it's very encouraging and could be potentially the continuation of the underground Trident mine, which was so successful for Alastair Gold. This is our drilling budget over the course of 2021, a 33% increase over 2020 in the areas that we're going to be targeting. About 50-50 split between resource development, which is increasing our resources and translating those into reserves, and then, of course, true exploration. Spargos, this is the last area I'll talk about before we wrap up with the company review, and then Paul and I will be happy to take questions from the audience. Spargos is a very high-grade open pit project that we acquired last year for $4 million. It's about 140,000 ounces at just over 4 grams per ton. We, of course, will be updating that resource in the second quarter of this year. But a very interesting drill hole was drilled in February of last year by the previous owners. That was 14 meters of 46 grams per ton, and it was just on the south end of the open pit. What we did last year was we followed up on that drill results, and anybody who's been invested in Karora will remember the day that these came out. Some truly fantastic drill results. I would argue, I spent 7 years as a mining equity analyst prior to this, to joining Paul here at Karora, and I would argue that these are some of the best drill results that were released in the world last year. Not just because it's an ounce per ton over 19 meters or an ounce per ton over 15 meters, but because these drill hole results are all within 100 meters of surface. That means that these drill results will be open pittable, and that is truly profitable material. So we'd certainly expect to see an uptick in grade when we're mining those specific areas. Not only that, but just a few weeks ago, or 2 weeks ago, I should say, we announced some additional drilling from Spargos where we are testing the extent of these high-grade plunging chutes. So these areas are occurring in these chutes that you can see labeled here. And what we did was we ended up testing the depth extent, and we returned a drill hole at depth. Well, I call it at depth. It's only about 250 meters below surface. That was 6.1 grams over 14 meters. That means that this chute has now been extended over 300 meters in plunge extent, which means we'll have an open pittable area as well as a potential underground area underneath Spargos once the open pit is exhausted. So very excited about Spargos. There's a similar deposit that's about 15 kilometers to the south that's called Wattle Dam, which is the foundational asset of Ramelius. We are excited to see what we get at Spargos and what we're able to uncover here, but stay tuned for more drill results there. The last area I'll wrap up on, I mean, the whole mining sector here, of course, has been suffering over the course of the last 6 months since our highs in August last year. We're very much trading in line, actually slightly better than several of our peers, but I would say that the value opportunity that's presented in the gold sector today is second to none, and certainly the macro environment for where we think we're going this year with gold prices has never been more conducive for strong gold prices. And in summary here, I'll wrap up. We obviously have some very strong institutional shareholders, but are very happy with the retail shareholders that we've had, some very strong and long holding retail shareholders, and we're happy to present to you today. We also have tremendous support from the analyst community. Last year, with no site visits completed, and I was a former analyst myself and would never launch coverage on a company without a site visit, we added 3 new analysts to our analyst pool here. We added Cormark, we added Canaccord, and we added my former shop, Stifel GMP. We expect more launches this year from more analysts that are very excited about this story. So you certainly have lots of research to read if you want to get a second opinion on what we're doing here, but we're very, very excited. So I think with that, it's probably a good time for us to turn it over to questions, and I'll turn it back to Dasha and Paul here.
Great, thank you so much. Yeah, it's a great time now to head into the Q&A, as there's lots of questions here. So we're just going to start with a question that was emailed in. As a byproduct credit at Beta Hunt, how much do you expect nickel to contribute to your overall all-in sustaining costs?
Thanks, Dasha. I'll take that one, Oliver, and we'll share the questions here. With respect to nickel, we have a huge advantage at Beta Hunt, where we're looking at today anywhere from $26 to $32 per ounce. Again, I opened up by saying we're very focused at reducing costs. So nickel today can contribute very close to $30 an ounce with what we know today. And look, we're doing a lot of drilling here. We continue to discover new nickel zones within the Beta Hunt mine. And with this drill program that's so aggressive this year, I won't be surprised if we discover more nickel. So not only are we a gold mining company, but we have the advantage of taking advantage of nickel prices 2 ways. With the sale of the Dumont property, we can get another up to $40 million Canadian into Treasury. And then that byproduct credit of nickel, as you say, Dasha, at Beta Hunt. And just to explain, we don't put the nickel through our own plant. BHP has a processing facility which is 4 or 5 kilometers away from our plant. So we have an agreement with them. We sell them a lot of 3,000 tons, and we continue to focus on the gold while we're still able to take advantage of those nickel byproducts. So long answer, but there's a little more information that needs to be explained with respect to how we can really take advantage of nickel in our operation.
We have Noam Cowan that says, hi, Paul. Thank you for the wonderful presentation. I'm wondering what the long-term focus is for Karora. Specifically, does Karora think the most attractive option is to upgrade the mill or purchase a new mill or purchase new properties or grow operations by focusing on exploration at Karora's properties?
Look, that's undoubtedly a great question. It's a large reason I'm going to Australia. Our first year was to focus the company on being a gold producer, reshaping the board, the executive team, the operational team. So what do we want to do long term? Where do we want to be? We would love to see ourselves, as I mentioned, anywhere from 200 to 250,000 ounces a year in the next couple of years. That can come from several ways. It could come from our drill bit. We have unlocked this whole district, so we have got tremendous organic growth opportunities in front of us. We've seen some very good success on the heels of some M&As. We bought Spargos. We paid $4 million for Spargos. Look at those drill results. I can't explain how excited I was when I saw those drill results from an open pit, mindful. An open pit that has, 1 ounce over 19 meters. So that's another way. We're going to be using all kinds of opportunities to make sure on a per share metric, what we're doing is accretive for our shareholders. We're going to make sure that we keep that, and we're always mindful of what we're doing. But getting to that 200 and 250,000 ounces a year is going to be, it's our vision here. And I'm very confident we will get there, actually. We have the assets, the location, and the team that can certainly deliver on that. So thank you for the question.
Mm-hmm. So maybe I'll jump in again until Dasha is able to come back.
Sure, yeah, sounds like we've lost her, Oliver. Go ahead.
Yeah. So another one I'm seeing here that's come in is, since you have started the Larkin currently at a lower rate until ventilation allows full-scale mining, have you mined any nickel there? And is the BHP concentrator available as soon as you do mine nickel to sell it?
Yeah, look, fantastic question. It was probably about 2 weeks ago. I had a picture from the mine myself. And again, I'm looking forward to being there on the ground, to going underground. Most of you know my experience is all operations underground. So I got a picture from the mine site where we had a face in a development area, a tunnel that was 7 meters wide. This was the picture that was sent to me. 5 meters of that picture was gold, averaging anywhere from 4.5 to 5.1 grams. So again, almost double what we're currently mining. The other 2 meters of the same picture, by the way, was nickel. So we had a face here that had gold and nickel participating in that same phase. So we're drifting through there, and we're not drifting at the best rate we can because of ventilation. And we're resolving that. Look, we're going to continue drifting. We're going to continue setting this up, and we'll be stoping in that in 2022, but as we put in the ventilation. So there's certainly an opportunity for gold and nickel. And this is a new discovery here, right? This is new here. The nickel zone we discovered was the first time in over 20 years. The Larkin Zone was a new discovery from our drilling. And as you asked, you're correct. Yes, BHP does take our ore. It's about 4 kilometers away. It's very, very close. I've been to site numerous times now. You drive by the concentrator to get to our asset. And we have an agreement with BHP to treat that. As soon as we get one lot of 3,000 tons, we ship that directly to them while we're transporting the gold to our Higginsville mill that we're going to be expanding this year. Look, we know that one of our constraints is the milling. So we've got to upgrade the milling, and we're going to look at different alternatives for milling in the future. We've got to look at that very quickly, actually. So thank you for that question.
The next question is from Jan. He says, hello, Paul, you do a perfect job. Can we expect 500,000 ounces in 5 years, or can we expect a dividend in gold?
All right. I love the aggressiveness. I'm always passionate about it. 500,000 ounces in 5 years. I'd say, look, that's aggressive. Could Paul Huet and our team do it? If anybody in the world can do it, we certainly could try. It's quite aggressive. Let's get ourselves to 250,000 first. Let's cross that $1 billion market cap, which I'm very confident we will get to. I think back of other companies I was responsible for that were much more challenging, that didn't have the opportunities or didn't have the same team. And we accomplished that in a more challenging gold environment. So I'd say 500,000 in 5 years, a little aggressive. Would we say internally that's something that we would want to do? Absolutely. Would we publish that we're going to get 500,000 ounces 5 years? I'd say I'd be very mindful and be reminded by my team, be careful. Let's walk before we're running here in this race. So that was the first part. And what was the second part of the question, Dasha? It was the dividend. Yeah, look, right now, dividends, we got $80 million in cash. We got the board to approve an NCIB, a shareholder buyback in 2020. We got that done. We, instead of looking at dividends, we're looking at our growth plans first and foremost, and using that cash to come back into our exploration and our growth plan. And investing in ourselves is undoubtedly the best thing we can do to create value for our shareholders. The best way to create shareholder value is on the drill bit or that growth plan and betting on ourselves. So preserving our cash for that, but we have been exercising that NCIB. We've been buying at an average about $3.10. And as a reminder, we had issued shares when we bought the Ramelius royalty at Spargos. That was a 3% royalty. We gave up 1 million shares at $3.75. $1 million, sorry, not a million. I apologize, not 1 million shares. Take that back. We gave up $1 million at $3.75. So we're out there in the market. We never wanted to give up that equity. we offered cash, and they wanted to participate in some of the upside, and you can't blame them. They said, look, we think you're really trading low. We want to participate in some upside so we can create more value for that royalty. So we issued them the stock. We've been issued it at $3.74. We've been buying it back at $3.10. And if you look on a daily basis, we've been out there buying it and continuing to buy on a daily basis, supporting the stock. So this is the first time I've been able to use an NCIB and truly take advantage of it and creating value for the shareholder. So I think the best bet for our cash now is to really drill and look forward to our growth plan and have that finance. Having no finance gap in a growth plan, that is a tremendous thing to have in front of yourselves here.
Yeah, and maybe one thing I'll add to that, Paul, is just in terms of being prudent stewards of capital, right? We look at every opportunity in terms of where we want to deploy our cash. We're not sitting on a $80 million kitty for no reason. As we talked about in the second quarter, we'll be outlining the growth plan to the investors, and any dollars that are spent outside of that growth plan, of course, we have to go back and find dollars to put into that growth plan. So it's very important that we deploy our cash flow back into how we're going to grow this company, and we look at the ROI of every dollar spent. So we're balancing between NCIB. Down the road, we will consider dividends if we have excess cash flow. The growth plan will be another part of this. So it's important to look at the whole picture and not just every single individual piece.
Right,
Thanks, Oliver. That's a good question, Dasha. That was a very good question from that person. So thank you.
So David is, first he's a statement. He says, hello, Paul. As a long-term holder in Karora Resources, I would like to say I'm very confident in you and your team's accomplishment and business model moving forward. His question is, when you came on, Paul, he remembers you stating that Beta Hunt RNC at the time was not up for sale. Is this still the case?
Oh, absolutely. Look, I'm moving to Australia. That is such a huge commitment for me and my family. There is no for sale sign on this company. We certainly absolutely believe we can create shareholder value. We're trading at such a discount here right now. With everything we have in front of ourselves, my commitment to move my family and children to Australia surely sends a message and a signal to say, wow, look, for those people who followed me in my career, if you think back of when I was CEO of Klondike, I was living in Canada. In order to make Klondike successful, I believed I needed to be there with the team on the ground, helping support them where my strengths lie. I relocated my family from Canada to the US, and there was some tremendous success those next coming years at Klondike. It's a big commitment to move a family with children who are in school. Moving over there is certainly the right thing for us to do and to support the ongoing events that we got in front of us, but certainly signals that we don't have a for sale sign here. We believe we can do for our shareholders as good as anyone else in the world can do for anybody if they owned our assets. And again, I'd rather be at the helm here, growing this company to that 200 to 250,000 ounces a year and beyond, and think big like that other person asked, can you get to 500,000 ounces? I love to hear that. I always ask that same question to my guys, and I pound it on the table. How do we get here? How do we get to that? So we're a long-winded response to say we're not for sale, but look, at the end of the day, if somebody comes in and makes a big offer, I have to take that to the shareholders. But I don't have a big for sale sign on our back at this point. Right. But if we've got to get the share price up, because we can be at risk with these low valuations. We've got to make sure that we're not a target for takeout. So we think that we can drive shareholder value like we did in our first year. So thank you for that question.
Great, thank you. Antonio is asking, are you going to expand the mill capacity in the long term, for example, over the next 5 years?
Yeah, so look, again, another great question. We're doing a mill expansion this year, and I like to hear Oliver sometimes. He calls it a debottlenecking exercise. He's speaking to our metallurgists all the time, and it really is that. So the first expansion that is coming is this year. We realize that because we have such great assets in a massive jurisdiction, that our bottleneck is the mill. And look, we started this early on, and I know I talked about ore sorters before. We've done two trials of it. They're still not off the table. We're still doing more trials of it. We want to evaluate things. there are potentials that we could expand that existing mill all the way up to 2.2 million tons per year. That's one of the big things I'm going to be looking at when I get there myself with Graham. Either we grow the mill to 2.2 million from the first phase that we're doing, or we look at other options here. We've got Mount Henry to the south. There's a lot to look at, and we're looking at it now. We've been looking at it for some time either. We haven't been sitting on our hands. In the first month we bought the mill, we started looking at ore sorters and mill expansion because we knew we would be here. So we're being quite proactive about it. We just need to finalize a lot of engineering work and decide where the tons are going to come from and how they're going to get treated.
Great, thank you. Ray says, great 2020. When can we expect the final results of the drill program started in 2020?
So I'll turn that one over to Mr. Oliver Turner. I said we would share the question. So Mr. Turner, if you want to take that.
Yeah, absolutely. So as I mentioned, there have been significant assay delays in Western Australia due to very good reasons. Everybody's drilling, everybody's sending their assays into the labs, and the labs just don't have the capacities with the personnel that they have right now to deliver them all in as timely a fashion as we would like. So we get them in batches. We have released those batches over the last several weeks. We now have all the Spargo assays in from our 12,000 meter drill program. So that's excellent and being rolled into our resource update in the second quarter. We'll get a few more drill results from Beta Hunt primarily over the course probably of the next few weeks. We do have some interesting nickel results that we're waiting assays on. We've seen some very exciting nickel core. We'll expect to update the market on some of those nickel results over the next several weeks here as well. But the majority of the results from 2020 are in at this point, and we're looking for some drilling to come back that we did in January of 2021.
Great, thank you. So how do you process nickel produced from Beta Hunt?
I'll take that one, Paul, if you don't mind.
Yeah, go ahead. Please go ahead, Oliver.
Yeah, so as we mentioned, BHP has their Kambalda facility right next door. Beta Hunt doesn't, and Karora don't have our own processing facilities on site. So it is something which works very, very well for us. They actually buy the ore right off of our surface in stockpiles. They send a truck over, and then they pay us for the metal content. So that gets treated 4 kilometers down the road at no additional cost to us. So it works very well.
Oh, great. That's perfect. So are you seeing cost pressures or constraints on labor, equipment, and supplies as a result of the ongoing COVID-19 situation?
Yeah, so we have been over the course of the year. There's a bit of a joke that goes around in Australia where they talk about the great country of Western Australia because they've sealed themselves off not only so well from the world but also from the rest of Australia. An important thing to note with Australia is that a lot of the labor there is fly in, fly out from other parts of Australia or nearby countries. A lot of the mining labor comes from outside of the state. So what we saw last year was a lot of those miners and talented personnel elected to stay home with their family rather than be subject to dual quarantines, 2 weeks coming in, 2 weeks coming out, so a month in total for a 2-week shift. So there was a constraint on labor over the course of last year that has carried over into 2019, but we're seeing with the success of the vaccination programs, and obviously Australia as a whole and Western Australia in particular has controlled COVID-19 very, very well. We expect those to ease off over the course of this year. So I got to tip my hat at this point to Graham and the team for navigating those labor shortages. At one point, we were down below 90% of our workforce, yet we still continued, as you saw with the quarterly results, to deliver our cost reductions as well as our ounce targets. So it was a great performance last year, and we certainly expect those pressures to alleviate as this year goes on. But it's not easy for any miner in Western Australia right now. On the flip side, it's a great time to be a miner there if you are in Western Australia because you have lots of job options.
Great, thank you so much. I did just realize that that's all the time we have for today. Thank you so much to Paul and Oliver for taking us through your company presentation, and thank you to everyone who submitted questions. If you didn't get a chance to get your questions answered, or you think of another one after the summit, we'll be emailing out a short survey, and the Karora Resources team will be happy to follow up with you directly, and you can get your questions answered by them. You can also find more information on their website at karoraresources.com. And we did record this presentation, so you can watch it again on 6.com afterwards. So thank you so much. I'll hand it back to Paul and Oliver for the final word.
Yeah, look, thanks, Dasha. I really want to thank you and Six for our first maiden summit here. This is one of numerous that we intend to do. We're looking forward to working with you guys. This is a different platform for us, and we hope that those people who had the opportunity to watch it and are going to watch it on record and enjoy this. Our intentions are really to communicate more, and we've been looking for numerous platforms to find a way to do that. So this is something that we're going to start doing more frequently. And I want to reiterate what Dasha said. Thank you for your questions. They were very good questions. I hope you like this format where we save 20 minutes at the end where we can start engaging and asking questions. We realize everybody's time is important. And taking an hour out of some people's day is a lot to ask. So thank you for taking that time. We appreciate you. We appreciate you as shareholders and look forward to serving you guys in the future. So thank you very much.